Hi, everyone. Steve Wyett, along with Matt Stephani, president of Cavanal Hill Investment Management. Before we get started this week, if you were on the invite list for our live mid-year update and were unable to join us, please look for an email with that or just click the link that's on your screen right now to go directly to that recording. We hope you will enjoy the comments and as we share our outlook. Matt, I want to start this week. Earnings are getting going. We're going to get about 19% of the S&P 500 this week, 39% next week. What's happening there, and kind of how is that impacting what's happening in the stock market?
So, Steve, earnings have been a little bit ahead of expectations thus far. We've had a few companies report, primarily the big banks, one of the airlines, as well as a few others. And we're seeing decent results. Now, we're still seeing conversations about tariffs, but I would argue that that has not shown up in results as of yet. And it's been our argument that a lot of the providers, the exporters, are going to end up paying a lot of those tariffs more so than the consumer. We're not seeing it in company earnings. So earnings look solid. You see revisions going higher, so that's taking the market up with it. But it's been a busy week last week from an earnings and an inflation standpoint, Steve. And I know that's a big focus of ours. What was your take on the inflation data and perhaps what that means for the Fed meeting next week?
Yeah, Matt, I'd have to say, as far as the inflation data, it's kind of like the earnings announcements. We keep expecting to see this impact. In fact, remember back in April when the tariffs rolled out, there was this idea that tariffs were actually potentially going to push us into a recession. But we got CPI out last week, PPI, import prices. And while there's evidence of some price increases in those areas where imports are the biggest part of supply, think appliances, apparel, toys, those prices are higher. If we just look overall, CPI was up 0.3% and core was only up 0.2. PPI was flat last week, and import prices, which were expected to be up something like 0.6, up 0.1%. So from the Fed's perspective, you're right. They meet here in a couple of weeks. They keep pointing to tariffs as a reason they haven't eased. That doesn't seem to be a problem. At the same time, Matt, just as you pointed out with earnings and everything else, the economy continues to roll along. The economy's not screaming for the Fed to ease either. So look for the Fed to stay stable. In fact, as we look at September, it's only about a 60% chance, still thinking the Fed will ease before the end of the year. But there's just nothing out there calling for them to move quickly. We're in the middle of summer doldrums, Matt. We never know, something would come up. The potential for a sell-off is there. I want to ask you real quickly as we finish, though, if we would see a sell-off in the market, 5, 10, or even 15%, how do you think we'd respond to that?
Steve, based on what the economic data has been over the last few weeks and months and what we see going forward, I'd expect that to be a buying opportunity in the market, frankly. I think that as you look at valuations being on the rich side, you can get a little too concerned about valuation relative to the constituency of the earnings. In other words, with tech and more stable companies making up a bigger percentage of the S&P 500 earnings, it's not surprising that the multiple is a little higher than what we've seen in the past. So I would see that any pullback, barring some exogenous event that we just can't predict, would be an buying opportunity in this market.
That plays exactly into our ongoing statement. We're more optimistic than pessimistic, certainly as we look longer term. Thank you for joining us this week. We'll look forward to talking to you again soon.
Thanks, Steve. Have a good day.